You know that feeling when you're watching your trade climb higher and higher? Your heart starts racing, and suddenly that voice in your head screams, "Sell now," before it all disappears. You click that exit button, lock in your profit, and feel that rush of satisfaction. But then something happens that makes your stomach drop. The price keeps climbing and climbing and climbing until you realize you just walked away from what could have been your biggest win of the month, maybe even the year. If this sounds familiar, you're not alone. Taking profits too early is the silent killer that destroys more trading accounts than bad entries ever will. It's the psychological trap that keeps good traders from becoming great ones. And here's what nobody talks about. The reason you're cutting your winners short isn't because you lack discipline. It's because you've been programmed to fail by your own survival instincts. Today, I'm going to expose the hidden psychology behind why traders sabotage their own success. I'm going to show you the 3 mental traps that are stealing your profits right now. And most importantly, I'm going to reveal the counterintuitive strategy that professional traders use to let their winners run, while everyone else panics at the first sign of profit. But before we dive deep, let me tell you about Marcus. Marcus was a software engineer who started trading with $5,000.
He was smart, analytical, and he'd spent months studying charts and strategies. His entries were precise. His risk management was textbook perfect. But Marcus had one fatal flaw. Every time he made money, he'd exit immediately. A $20 profit felt safer than risking a $50 loss. A $100 gain was better than watching it potentially turn into a $200 disaster. For 6 months, Marcus celebrated small wins while watching massive opportunities slip through his fingers. His account stayed flat while the market handed him countless chances to multiply his capital. Sound familiar? Marcus was trapped in what I call the certainty cage. His brain was wired to choose guaranteed small rewards over uncertain large ones, even when the math clearly favored holding longer. This isn't a character flaw. This is human nature working against human wealth. The first mental trap that's stealing your profits is called loss aversion. Your brain is hardwired to feel the pain of losing money twice as intensely as the pleasure of making the same amount. Think about it. How does it feel to lose $50 versus how it feels to make $50?
The loss stings more, doesn't it? This asymmetry in how we process gains and losses creates a devastating bias in our trading decisions. When you're sitting on a profitable trade, your brain doesn't see potential for more profit. It sees potential for loss. Every green candle that moves in your favor triggers anxiety instead of excitement because now you have something to lose. The bigger your unrealized profit grows, the more your brain screams at you to lock it in before the market takes it away. Professional traders understand this psychological warfare, and they've learned to flip the script. Instead of seeing unrealized profits as money they might lose, they see it as evidence their analysis was correct. They've trained themselves to view pullbacks not as threats to their gains, but as natural breathing patterns in a healthy trend. But here's where it gets interesting. The fear of giving back profits isn't just about loss aversion, it's about identity protection. When you take a quick profit, you get to tell yourself a story. You were right, you made money, you're a successful trader. But when you hold and watch that profit shrink, even temporarily, your ego takes a hit. Your identity as a smart trader gets questioned.
This is why cutting profits early feels so good emotionally, even when it destroys you financially. You're not just protecting money, you're protecting your self-image, and your brain will sacrifice long-term wealth to preserve short-term identity every single time. The second trap is what psychologists call the certainty effect. Your mind places disproportionate weight on outcomes that are certain versus outcomes that are merely probable. A guaranteed $50 profit feels more valuable than a 70% chance of making $200, even though the math clearly favors the uncertain option. This bias becomes lethal in trading because the market never offers certainty. Every trade you hold could reverse at any moment. Every profit you're sitting on could vanish with the next candle. Your brain knows this, so it pushes you toward the one thing that feels certain, taking the money now. But here's what they don't teach you in trading courses. The certainty you're chasing is an illusion. The moment you exit a profitable trade, you're not eliminating uncertainty, you're just shifting it. Now you're uncertain about whether you'll find another good setup. You're uncertain about whether you left money on the table. You're uncertain about whether you made the right decision.
Professional traders embrace uncertainty instead of fighting it. They understand that profitable trading isn't about eliminating risk. It's about managing it intelligently while letting probability work in their favor over time. They've learned to be comfortable being uncomfortable, and that comfort with discomfort is what allows them to hold winning trades longer than amateurs ever could. The third trap is the most insidious because it disguises itself as wisdom. It's called the reference point bias. Your brain doesn't evaluate profits in absolute terms. It evaluates them relative to some arbitrary reference point you've established in your mind. Maybe you entered a trade hoping to make $50. When you're up $40, that 40 feels disappointing because you're measuring it against your $50 expectation. So you hold, hoping to reach your target. But then the trade moves to $60 profit, and suddenly that 60 feels amazing because now you're measuring it against your original $50 goal. This constant shifting of reference points creates emotional chaos. One moment you're disappointed with good profits. The next moment you're euphoric about the same profits. This emotional inconsistency leads to inconsistent decision-making, which leads to inconsistent results. Here's what separates professional profit-taking from amateur profit-taking. Professionals don't use arbitrary targets based on round numbers or wishful thinking. They use dynamic exit strategies based on market structure and momentum. They let the market tell them when the move is exhausted instead of imposing their own timeline on price action. They understand that the best trades often go much further than anyone expects. They've learned to scale out of positions gradually, taking some profits to satisfy their psychological need for certainty while letting the remainder run for maximum potential. This approach manages their emotions while maximizing their mathematics. But here's the part that will shock you. The biggest profits in trading don't come from being right more often. They come from being wrong less expensively and being right more lucratively. Average traders focus on win rate. Professional traders focus on profit factor. They're willing to be wrong 7 times out of 10 if their 3 winners more than compensate for their 7 losers. This mindset shift from frequency to magnitude changes everything. When you're focused on win rate, every profitable trade feels like a victory you need to secure immediately. When you're focused on profit factor, every profitable trade becomes a potential home run you want to let develop fully. The cruel irony is that by trying to guarantee small profits, you're actually guaranteeing small account growth. By being afraid of giving back gains, you're ensuring you'll never make the gains that could change your life. The very behavior that feels safe in the moment is the behavior that keeps you trapped in mediocrity forever. But there's hope. Once you understand these psychological traps, you can start building systems to overcome them. You can learn to let your winners run while managing your emotions. You can discover the freedom that comes from trusting your process instead of micromanaging every tick. The transformation doesn't happen overnight. It requires rewiring decades of evolutionary programming that served our ancestors well, but sabotages modern traders. Your brain evolved to survive in environments where immediate threats required immediate action. When a predator appeared, hesitation meant death. When food was available, eating it immediately meant survival. But trading operates in reverse. The immediate action your brain craves is usually the wrong action. The hesitation your instincts fight against is often exactly what profitable trading requires. You're essentially asking your Stone Age brain to operate in a space-age environment, and the disconnect creates the internal conflict that destroys your results. This is why willpower alone will never solve your profit-taking problem. You can't simply decide to hold longer and expect it to work. Your emotions will overpower your logic every single time because emotions are faster, stronger, and more persistent than rational thought. What you need is a systematic approach that works with your psychology instead of against it. The first step is understanding that your current exit strategy is probably based on hope rather than logic. Most traders set profit targets by asking themselves how much they want to make, instead of asking what the market is likely to give them. They look at their account balance, calculate how much they need to reach their monthly goal, and set targets accordingly. This backwards approach guarantees frustration because you're imposing your personal needs onto an entity that doesn't care about your needs. The market moves based on supply and demand, institutional flows, and mass psychology. It doesn't move based on your rent payment or your vacation plans. Professional traders approach exits differently. They study market structure before they enter. They identify key support and resistance levels where institutional traders might take profits. They analyze momentum indicators to gauge the strength of the move. They prepare multiple scenarios and plan their responses to each one before risking a single dollar. This preparation creates what psychologists call implementation intentions. Instead of relying on willpower in the heat of the moment, you've already decided what you'll do in various situations. When the trade reaches your first target, you'll take partial profits. When momentum starts to wane, you'll tighten your trailing stop. When price breaks key support, you'll exit completely. Having these predetermined rules removes emotion from the equation because you're not making decisions under pressure. You're simply executing a plan you created when your mind was clear and objective. This is how professionals stay calm while amateurs panic. But even the best exit strategy means nothing if you can't execute it consistently. This is where most traders fail. They create beautiful plans and then abandon them the moment real money is at stake. The solution lies in understanding the difference between mechanical rules and adaptive principles. Mechanical rules are rigid and specific. Exit when price hits exactly $50 profit. Close the position at 3 p.m. Eastern Time. Take profits when the RSI reaches 70. These rules work well in backtesting but often fail in live trading because markets are dynamic and constantly changing. Adaptive principles are flexible guidelines that account for changing market conditions. Exit when momentum clearly weakens. Close the position when institutional support breaks. Take profits when the risk-reward ratio no longer favors holding. These principles require more skill to implement, but produce better results because they respond to what the market is actually doing rather than what you hoped it would do. The key is finding the balance between structure and flexibility. You need enough rules to prevent emotional decision-making, but enough flexibility to adapt when market conditions change. This balance comes from experience, and experience comes from deliberately practicing better exit strategies, even when it feels uncomfortable. Consider the story of Jennifer, a day trader who struggled with the same profit-taking issues as Marcus. She would enter strong momentum trades and exit within minutes, watching helplessly as they continued running for hours. Her win rate was impressive, but her average win was tiny compared to her average loss. Jennifer's breakthrough came when she stopped focusing on dollar amounts and started focusing on market behavior. Instead of setting arbitrary profit targets, she learned to read momentum shifts and institutional footprints. Instead of exiting when she felt nervous, she scaled out gradually as logical reasons emerged. The change wasn't immediate. For weeks, Jennifer felt constant anxiety as she held trades longer than her comfort zone demanded. Her old patterns fought against her new approach. But slowly, her average winning trade grew larger, while her win rate remained stable. Her monthly results transformed from mediocre to exceptional. Jennifer's success came from understanding that trading is ultimately a game of patience and positioning. The traders who make life-changing money aren't necessarily smarter or more skilled. They're simply better at letting profitable situations develop fully before cutting them short. This patience isn't passive waiting. It's active monitoring and dynamic adjustment based on evolving market conditions. It's the difference between hoping a trade will work and knowing when a trade is working. It's the difference between gambling on outcomes and managing probabilities. The most successful traders think in terms of expected value rather than individual results. They understand that maximizing long-term profits sometimes means accepting short-term discomfort. They've learned to measure success by process quality rather than outcome satisfaction. This shift from outcome-focused to process-focused thinking eliminates the psychological pressure that causes premature exits. When you're judging your trading by how well you followed your plan rather than how much money you made today, holding profitable trades becomes easier because you're not constantly evaluating whether to lock in gains. Your focus shifts to executing your system with precision rather than micromanaging every price fluctuation. You stop asking whether you should take profits and start asking whether your original thesis remains intact.
This subtle change in perspective transforms everything because you're no longer fighting your emotions, you're channeling them into productive analysis. But here's where most traders get confused. They think letting winners run means holding every profitable trade until it reverses. Real profit maximization requires knowing the difference between a trade that's building momentum and a trade that's losing steam. It requires reading the subtle signals that separate continuation from exhaustion. Professional traders develop what I call market intuition. They can sense when a move has more room to run and when it's approaching natural resistance. This isn't mystical ability, it's pattern recognition built through thousands of hours of screen time. They've seen enough winning trades to recognize the characteristics of moves that go further versus moves that stall out. The development of this intuition happens gradually. You start by observing how profitable trades behave after you exit them prematurely. You study the price action that follows your early exits. You begin to notice patterns in volume, momentum, and institutional behavior that signal whether a move has legs or is running out of steam. This observation process is painful at first because you're constantly reminded of the money you left on the table. But this pain serves a purpose. It's training your brain to recognize the cost of impatience. It's showing you in real dollar terms what your fear is actually costing you over time. Eventually, something clicks. You start recognizing the difference between healthy pullbacks and trend reversals. You begin to trust momentum indicators when they suggest a move is just getting started. You develop confidence in your ability to ride trends longer because you've seen enough data to know that most good trades go further than your initial comfort zone suggests. This evolution doesn't eliminate the anxiety of holding profitable trades. It just changes how you respond to that anxiety. Instead of immediately acting on nervous feelings, you pause and analyze what's actually happening on the charts. You ask whether your fear is based on logical market signals or emotional discomfort. The next time you feel that familiar urge to lock in profits early, remember this. Your brain isn't trying to sabotage you. It's trying to protect you using outdated programming that worked in a different world. But trading success requires you to override those instincts and trust the process you've built. Stop settling for small certainties when the market is offering you large possibilities. Your future self will thank you for learning to let your winners run.